price rate of change, ROC, is a momentum-based technical indicator that measures the percentage of change in price between the current price and the price a certain number of periods ago. One potential problem with using the ROC indicator is that the calculation gives equal weight to the most recent price and the price from nth periods ago, despite the fact that some technical analysts consider the most recent price action to be more important in determining likely future price movements. The price rate of change, ROC, is a momentum-based technical indicator that measures the percentage of change in price between the current price and the price of a certain period of periods ago. The primary difference is that the ROC divides the difference between the current price and the prices n periods ago in the n periods ago. For example, if a stock's price is rising over a period of time while the ROC is progressing, moving lower, then the ROC is indicating bearish divergence from price, which signals a possible trend change to the downside. Some key takeaways. The price rate of change, ROC oscillator, is an unbound momentum indicator used in technical analysis set against a zero level midpoint. A rising ROC above zero typically confirms an uptrend, while a falling ROC below zero indicates a downtrend. When the price is consolidating, the ROC will hover near zero. In this case, it is important traders watch the overall price trend, since the ROC will provide little except for confirming the consolidation. Common uses. As ROC purely measures momentum, traders' quote usefulness is most seen as a filter or confirmation signal. Deriving primary signals is difficult without the confluence of the technical indicators. One of its major utilities is being able to indicate divergences, overbought and oversold areas. These are plotted as spikes out of the average range in either direction. Summarizing, the ROC helps you identify oversold and overbought areas. Refrain from trading if there's a lack of momentum. Validate a signal by using an ROC for confluence. Using ROC in trading. Here's how to trade the signals generated by the ROC indicator. Overbought and oversold conditions. Momentum indicators are particularly ideal for trading ranging markets because they help forecast turning points accurately. Momentum generally refers to a trend continuing to its course, and in a ranging market, if a trend starts to lose momentum, it is best to start looking for opportunities to trade in the opposite direction. Peaks and troughs can occur after a certain period of time has elapsed or when a certain percentage move has been made. As an unbound indicator, ROC gives a clear picture of when to anticipate such turnarounds based on previous printed indicator levels. It is well recognized phenomenon that the security prices surge ahead and retract in a cyclical wave-like motion. This cyclical action is a result of the changing expectation as bulls and bears struggle to control prices. The ROC displays the wave-like motion in an oscillator format by measuring the amount that prices have changed over a given time period. As prices increase, the ROC rises. As prices fall, the ROC falls. The greater the change in prices, the greater the change in the ROC. The time period used to calculate the ROC may range from 1 day, which results in a volatile market showing the daily price range, to a 200 days or longer. The most popular time periods are the 12 and 25-day ROC for short to intermediate term trading. These time periods were popularized by Gerald Apeel and Fred Hitzler in the book Stock Market Trading Systems. The 12-day ROC is an excellent short to intermediate term overbought oversold indicator. The higher the ROC, the more overbought the security. The lower the ROC, the more likely a rally. However, with all overbought and oversold indicators, it is prudent to wait for the market to begin to correct, turn up or down, before placing your trades. A market that appears overbought may remain overbought for some time. In fact, extremely overbought or oversold readings usually imply a continuation of current trend. The 12-day ROC tends to be very cyclical, oscillating back and forth in a fairly regular cycle. Often price challenges can be anticipated by studying the previous cycle of the ROC and relating the previous cycles to the current market. The following chart shows the 12-day ROC of Walgreens expressed in percent. Drew buy across each time the ROC fell below and then rose above the oversold level of minus 6.5. I drew sell arrows each time and the ROC rose above and then falls below the overbought level of plus 6.5. The optimum overbought oversold levels plus or minus 6.5 vary depending on the security being analyzed and the overall market conditions. I selected plus or minus 6.5 by drawing a horizontal line on the chart that isolated previous extreme levels of Walgreens' 12-day ROC. Breakouts. Breakouts occur with strong momentum, and what better indicator to qualify breakouts than the ROC? When the price is consolidating or ranging, ROC will print flat values. A sustained sharp rise or fall will confirm that the breakout trend will be sustained going forward. Zero line crosses. A zero line cross on the ROC is an indication that a new trend is forming. A cross of the zero line from below indicates that a bull trend is now in place, whereas a cross from above indicates that a downtrend is now in place. As mentioned above, it is important to consider asset volatility and time frame charts to minimize false or whipsaw ROC signals that come from the zero line crosses. Divergences. Divergences are great for timing market turning points, and with the ROC being a momentum indicator, it can deliver accurate and compelling divergence signals. Bullish divergence will occur when the price is falling lower lows but the ROC is printing higher lows. This will be a signal that the downtrend lacks momentum and a trend change to upside is about to occur. Similarly, a bearish divergence will occur when the price is forming higher highs but the ROC is printing lower highs. This will be a signal that uptrend lacks momentum and a trend change to downside is about to occur. It is important to note that sometimes a divergence signal may take a little longer to play out, and it is important to seek confirmation from the other tools or even price candles to identify optimal entry points. The rate of change ROC indicator, which is also referred as a simple momentum, is a pure momentum oscillator that measures the percent change in price from one period to next. The ROC calculation compares the current price with the nth periods ago. The plot forms an oscillator that fluctuates above and below the zero line as the rate of change moves it from positive to negative. As a momentum oscillator, ROC signals include center line crossover, divergences, and overbought oversold readings. Divergences fail to foreshadow reversals more than not, so this article will forego a detailed discussion on them. Even though centerline crossovers are prone to whipsaw, especially short term, the crossovers can be used to identify the overall trend. Identifying overbought or oversold extremes comes naturally to the rate of change oscillator. ROC and momentum. ROC and momentum are two very different indicators designed to help traders decipher a similar price element, momentum. Both indicators tell a similar story that can be used interchangeably. The main difference between the two lines is the calculation. ROC values are expressed as a percentage, while momentum indicator values are absolute values. Also, ROC has a 0 as the center line, while the momentum indicator has 100 as the center line. Other that the traders decipher momentum information include MACD, RSI, ADX. MACD traders watch out for its histogram to determine its price momentum. A rising slope of the histogram denotes increasing bullish momentum, while a falling slope implies increasing bearish momentum. RSI has a center line at 50. A cross above 50 indicates that an uptrend is gaining momentum, where a cross below 50 indicates prevailing downtrend is more momentumous. ADX is a non-discretional momentum indicator that qualifies trends. ADI prints values of between 0 and 100, with values above 25 indicating that the prevailing trend is gaining momentum, whereas the values below 25 show the prevailing trend is weak. ROC and other technical analysis tool. As pointed out before, ROC may sometimes deliver early or late signal. It is therefore important to seek effective indicator combinations with the ROC that will help generate confluence signals. Here are some of the best ROC. ROC and stochastics. This combination is best for timing trend reversals. When the ROC delivers a divergence signal, traders can watch for the stochastic crosses in overbought or oversold zones to pick out optimal entry points in anticipation of a trend change. For instance, in the case of a bullish divergence, the best entry point will be in an oversold territory. ROC and the moving average. The ROC zero line can sometimes deliver vague signals to confirm the trend change. To confirm trend reversal, traders can combine the ROC with 2. For instance, when the ROC has just crossed the zero line from above to signal a downtrend, additional confirmations will receive when the faster moving average crosses the slower moving downwards. Bottom line. The price change indicator is abbreviated as ROC. It is a momentum indicator that measures the percentage change in price, providing traders with information on how quickly the price rises or falls. The obvious takeaway is that the faster the price changes, the stronger the trend's momentum. Overbought and oversold conditions, divergences, and center line crossovers are all common uses for the indicator. Because of this proximity for whipsaws, the indicator is used as a confirming indicator. The rated change oscillator measures the speed at which prices are changing. An upward surge in the rated change reflects a sharp price advantage. A downward plunge indicates a steep price decline. Even though chartists can look for bullish and bearish divergences, these formations can be misleading because of the sharp moves. Sustained advantages often start with a big surge out of the gate. Subsequent advances are usually less sharp, and the causes of bearish divergence to form in the rate of change oscillator. It is important to remember that the prices are constantly increasing as long as the rate of change remains positive. Positive readings may be less than before, but a positive rate of change still reflects a price increase, not a price decline. Like all technical indicators, the rate of change oscillator should be used in conjunction with other aspects of technical analysis. So for the rate of change ROC, study it, analyze it, adapt it. Peace.